you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Aloha, everyone. This is Harold Green of Bright Tree Wealth Management, and it is time to stop doing what you hate. I hope you are having a fantastic day today. Pretty early for me, Sunday morning. I normally don't record on Sunday mornings, but if I do record on Sunday mornings, it's because of like I have things in my mind, or I'll dream about something, and that'll get my mind going, and then I'll wake up and it's like 2:00, and I can't go back to sleep because my mind is just going. And so this morning I got up and did my devotionals, Bible study, things like that. Did some research on some things, and I just kind of started to look back on my life here recently, and I feel like I have a little bit of confession to make on a personal note. And I was reading a quote by somebody, and they were talking about front loading success. I don't know if you heard about that, but when you're young, you work really hard, front load your success, you sacrifice a lot, and you go at it. And I remember doing that when I was in my early 20s. I had a young family, and I was home, but I was always working. I was working a lot, trying to make bonuses and different things like that. And whatever the structure was for my compensation, I was always trying to make things happen. And I learned very early on that the early bird gets the worm. And so, if you're out there hustling early and you're getting things done, I just didn't know how beneficial that would be for me until just recently. I mean, a lot of things I've been working on have paid off, but except in this one area. And it was like, man, I've lost a lot of weight, but it's kind of like, man, how do I get down to the next level? And I just kind of felt like I hadn't been giving it everything I got. So I was like, yesterday I said, okay, today you're going to make a change. You're going to do a hard reset. And sometimes hard resets are necessary. So I did a hard reset on my diet, and I said, all right, let's see how many days in a row I can win this hard reset. So I decided to, first of all, I'm going to reset my breakfast. And so I'm going to have this type of food for breakfast, and I'm going to keep it like that for as long as I can. And then see if I can just make that a habit that, when I have breakfast at home, this is what I'm going to do. And I'm going to try to win that situation every single time. And I began to look at the market, I began to look at my diet like how I look at the market. And because this is a show about investments, all investments do carry risk of loss. Past performance is no indicator of future results. And if you're going to invest, make sure you do your due diligence, understand your time horizons, your risk tolerance, and make sure you're investing according to a well-balanced, comprehensive financial plan that has all your goals and your dreams, and maybe even some of your wants taken into consideration. And so, I mean, I'm very aggressive when it comes to my investment strategy. I'm very aggressive when it comes to my investment research. And lately I said, okay, you have several doctors, you have consultant doctors, you have a lot of people on your team that are giving you certain types of advice. And my question to myself is, how diligent have you been in following what they are telling you to do? And then how diligent are you being in doing your own research outside of what they're telling you? So I started doing research on my diets, certain supplements, things like that. And then one thing led to the other, and I ended up picking up some different supplements through, one of my doctors who, he's actually my chiropractic doctor, but he's also like my functional movement doctor as well. And he kind of tells you how the body's supposed to move, and then helps you with aligning your body the right way and different things like that. And so I said, okay, got it. So picked up my supplements from him, got some other supplements from online, and decided to make that adjustment in my diet for the hard reset. And I'm actually feeling pretty cool about it. I'm actually feeling pretty good today. It's probably why I couldn't sleep, because I had energy. I woke up, I was like, hey, I didn't wake up sluggish. I was like, hey, this feels pretty cool. I went to bed at 8:30 yesterday, and I was up at 2. I was like, hey, I want to sleep till 3, but it's like, hey, get up and get this done. And so I kind of been thinking about what to share with you folks. And so today, what I want to do is I want to do a stock market review, and just kind of let you guys know where we've been, what's been happening, and where I think things are going to go. So are you ready? 1, 2, 3, let's get it. So a year-to-date review. And we came into 2025 like pretty stoked, pretty excited, like pretty hyped, like, yo, this is going to be a great year. Yo, like, yo, let's get it. And then around March, so Will started to fall off this thing. And it was all about the tariff talk and different things like that. And the country is like deeply divided, deeply divided, like 50-50 divided, right? And but one guy won the presidency and one side was happy, the other side was kind of upset. And that kind of spilled over into the marketplace because when you have the media that hates the guy that's in power, they drove such a hard narrative that it was just honestly, I have never seen anything like this, like what happened in my entire life. And I'm 52 years old. That's a long time to be alive, 52. And to me, that's kind of long. I've been through a lot of stuff. So I feel like 52 in dog years is like 130 for me. But it was crazy. And I began to look at things like the CNN Fear and Greed Index. And, I read CNN and stuff like that. And I just I began to look and see the things that they were saying. And so I would read, and then I would just look at the numbers and say, you guys are so freaking disingenuous. It just makes my stomach hurt. They're so disingenuous. The numbers are saying one thing. You guys are saying something totally different. And they got the fear and greed index all the way down to a 3 on the index meter. I had never seen it that low before. Like extreme fear. People were selling. They were scared. Tariffs is going to ruin everything. The country's going to fall apart. We're going to go like all of these crazy narratives were being driven. And it bled over into the AAII consumer, investor survey, sentiment survey. And on 3/12/2025, this is what it read. Bullishness was 19.1. That is pretty low. Neutral was 21.7, but bearish was 59.2. And to me, this is where we were sitting here every day, just watching the market melt. And we were like, okay, what do we buy? I mean, we had a lot of cash at that time. And so what we did was we simply loaded up in our portfolios for our clients. And of course, for myself, which I've always done. And I just began to share with everybody like, hey, this is a media driven narrative. This is not even real, right? This hurricane that they're creating is not even a real one. It's a fake one. But yet you're boarding up your house, selling all your stuff because of what somebody's saying on TV and what they're saying in the media, all because they hate the guy that's in power. They want to make the guy look bad. And this is where I began to tell my clients, you have to turn off the news. You got to turn off the media because they're disingenuous. And someone said, well, how can you believe that they're disingenuous? As I see the numbers in front of my face. You're lying to me and telling me that the sky is orange and I see it's blue. Like, if I had my eyes closed, yeah, I'd believe you, probably, depending on how many times you said the sky was orange. But if I just open my eyes, I would know that you're lying. Like, a lot of people are walking around with their eyes closed, just kind of believing what they hear. The Bible says the simpleton believes everything that he hears. The simpleton, the simple-minded person believes everything that he hears. And so I was telling my clients, like, you know what? Turn that garbage off. Because in times like this is when we need to load up. Sure enough, we loaded up and things changed and our clients made a lot of money. And we began to sell when the market got over to greed, now extreme greed. So you had the CNN Fear and Greed Index get over to extreme greed. So that's when we started to lighten up. As these guys were piling back into the market, we were lightening up and creating a lot of cash. And so one of the things that we talk about is we talk about seasonality. All right. We talk about seasonality. And historically going into August has been weak. September has been negative. Then it picks back up in October, November, December, January. Everybody's all euphoric. Come February, the credit card bills hit from Christmas. Ain't nobody got no money to buy no stocks. And it's just like, here we go, start the cycle again. March, April, May picks back up into June, July. Everybody's feeling good. It's summertime. You lost that weight. Now you're out at the beach. You're chilling. Everything is good. Market is good. Then, boom, August comes around, starts all over again. We'll call that seasonality. And there's reasons for that, which I'm not going to get into today. But heading into seasonality now, I want to talk about, too, how you should be thinking about positioning your portfolios and how we're positioning our clients' portfolios But I want to go talk about some other information, some other real data. I'm not going to call this part of the conversation facts over foolishness. Facts over foolishness. Okay. Now, whenever you start talking about price increases and different things like that, you also have to look to see if there's another side of that, a backside of that, where, give you an example, tariffs may be raising the cost of certain goods and services and different things like that. But what's keeping them from being like a major just disaster in the overall economy? Number one, they're targeted. Not every single item in the store it has a tariff on it. You're not going to go to a store and buy every single item in that store. And the media makes it sound like that's exactly what you're going to do. You're going to go to the grocery store, everything has a tariff on it. You're going to go to Home Depot, everything has a tariff on it. You're going to buy something from Walmart, everything in Walmart has a tariff on it. It's like, are you kidding me? We already know that the tariffs are targeted. We know that. That is a fact. But the narrative that's being driven is something entirely different. So oil prices, if we just look at oil prices and just say fuel prices, because it costs money to ship things around the country and around the world. So right now, the national average is 3.137. And it says you got to go back to 2020 for a lower national average. And that was on August 21st of 2020. That was $2.18. Like, are we really going to see gas under $3 a gallon? Yes, in certain states, we are seeing gas under $3 a gallon. Is it going to go back to one? I don't think so. At $1 plus, I mean, it could. I don't know. I don't have a crystal ball. But if prices continue to come down, oil price comes down, and I believe inflation is going to come down, or it's going to stay kind of neutral. And so Paul came out and said, hey, we need to like relook at how we're talking about this inflation number. We don't know if it's ever going to go back down to 2%. Like, you would need gas like less than $1 or $1 plus in order to get it. That's just my opinion. I'm not an economist, but I 1 + 1 should equal two, not 4, 5, or 6, but 1 + 1 should equal 2. All right. That's basic mathematics. And so if oil prices continue to drop, inflation should also continue to drop. But one of the things that we looked at was the services part of the inflation number, or the PPI, CPI. It was services. And this is not what they told you. And so I was sharing with my clients, or with a client, that the reason why the PPI number came in hot was because of services and service fees. And they pointed out to like investment management fees and fees around the investment world. And it went up drastically. You know why? Because the market rallied so hard from April until July. It was insane. So a lot of times investment advisors get paid based on the assets under management. Even if they're charging 1%, if your assets go from, say, 200 million to 400 million, they double, then your fee on that 200 million to the 400 million goes up, and they count that number in the services. And that's not fair to the people who don't have money invested. The Fed looks at that stuff. Inflation is going to stay high. We need to keep rates high, and they're smashing everybody. So we looked at that and said, okay, I get it. But it was, the sell-off that we had recently here in August has been short-lived because people came back and they bought again. So moving forward, I want to talk about the positioning going into a rate cutting cycle, or a monetary easing cycle. And there's a couple of different things happening right now that hasn't really hit the market. So number one, you have the changes in fiscal policy, where there's a lot of deregulation going on right now. There's going to be a lot of spending, a lot of building. The tax bill is going to hit. Companies are able to expense 100% of what they're doing right now. They don't have to depreciate over the so many years that, according to the accounting rules, they can, boom, 1 year. So there's going to be massive spending, and they're already starting to do that right now. And then number two, you got rates that are going to be cut slowly. Some say, we're looking at 100 basis points in the next few months or so. That's a lot. If it happens, that's great. But here's what you got to understand. Whenever you're going into a rate cutting cycle, there's going to be what I call some false starts. And what I mean by that is, let's say, for example, normally in a rate cutting cycle, people start piling into small cap stocks because rates go down. Small cap companies can borrow more money at less cost, and they become profitable. So Small cap, then you go to mid cap, and then large cap has been winning this whole time. And before last year, whenever Powell cut rates, people got into small cap. The bond yields did a head fake and said, wait a minute, they were going down to 3.56. Powell and those guys cut rates. The bond market said, what you guys doing? We don't think so. They climbed back up to 4.7. That was insane. Small caps took a huge hit. People lost big bucks because they were too early in that trade. Me, I didn't think it was going to work. I did not pile into small caps at all. We have some small cap exposure, but we played the options on small cap stocks, but we did it for disruptive tech. And I'm not going to get into what I call disruptive tech, but we're buying options on disruptive tech because they were saying Nvidia and all these guys are overpriced or overvalued. You got to go look for stuff that nobody's looking for and tech that's not, on fire and that's going to be coming on strong. So that, yeah, okay, I get it. Yeah. So we have some of that in our portfolios, and we have very little mid cap stuff in there. And we have mostly US domestic large cap growth stocks and options on those stocks in our portfolios. But heading into the rate cutting cycle, you need to look at repositioning your portfolio a little bit, not a lot, just a little bit, just in case there's a false start, just in case we don't get as big of rate cuts as we're expecting along the way. So yes, we've added to our small cap stocks slowly, and I think it's going to work out this time around, but we have to go in slowly. Now, again, I do think inflation is going to go down. I think the tariff narrative, I think the deals are going to get put in place eventually. Something's going to have to break, something is going to have to give, but slowly buy in on the dips, slowly buy in on the dips. If you find something that you like and you've done your research, you got to slowly buy in on these dips, because we're still over here in extreme greed, and that's a very dangerous sign. The market probably still has furthermore to pull back. We don't know, but based on the AAII investor survey sentiment, people are still feeling really negative, right? And here's the other thing that's going to happen, I believe, and my wife and I talked about this. She has a real estate license, and the life cycle has been disrupted. And here's what I mean. Young families can't make that move up. They're stuck in the smaller houses. They bought their first time home and they're stuck. They can't move up. Rates are too high. The seniors who are in their dream home that they, successfully got into when prices were lower, interest rates were lower, ton of equity, they're aging. They want to downsize and get a smaller place that they can maintain. So the shift that normally occurs has not happened. Therefore, we don't see heavy buying of the refrigerators, the washers and dryers, and different things like that. Things that people upgrade when they're buying a new house, the furniture, and so on and so forth. Those markets have not moved. And then you have the whole tariff talk. So that's put a damper on the market. But I do think out here in Vegas, based on what I see, it has the number 3, it's the third highest default rate in the country behind Florida and I think another state. People are defaulting on their homes. And that underlying segment of the economy is not doing well at all. The rich are getting richer. Everyone else below that, they're getting hit really hard. And I did a series a little while ago about how to make up investment losses in your portfolio. And if you still haven't made up these investment losses from April, you're still behind the 8 ball because you're either too scared to get back in. I think we need to have a conversation so I can kind of talk to you about where you are right now and basically where you need to be. Me personally, I think we have another maybe 3-4 year runway on this next market that's going to take the next leg up. I think it's 3 or 4 years. But you're going to have some pullbacks along the way. You can have a 5% correction, 10% correction, 15% correction, and some stocks can even see a 20% correction. It just kind of depends on the narrative that is being driven. I still think our technology thesis is in place, but I'm working on a new thesis around disruptive technology that is about, I would say it's about 5 to 6 years away. Because when the economy changes and more people, the rising tide is lifting up more boats, you're going to see people looking for things, a lifestyle of convenience, and there's going to be technology that will make life extremely convenient. And one of the things I'm looking at, I'm going to say this out there, and I may sound crazy, but I think in the future, you're going to be able to buy a refrigerator that will buy your groceries for you based on what you've been diagnosed with. So, for example, if you have diabetes, your refrigerator will only order food that will help, reduce your diabetes and eliminate it. You can eat it away. Same thing with certain cancers or whatever it might be. Whatever the disease may be, your refrigerator will say, based on all of this AI research, this is how we recommend you eat. Here are some meals that you can order, and there will be food companies that will automatically cater to that, like that thing, say diabetes. And I believe you'll be able to put in your DNA or whatnot, and the refrigerator knows, okay, in order to make you satisfied, mentally, you normally go for French fries. We will say, go for nuts. It'll give you the same feeling of psychologically. And you're like, hey, okay, something crunchy. I mean, I'm telling you, I think that down the road, we will have this kind of technology. And there are already companies out there that are working on developing this right now, even as I speak. They're probably not going to say it because, again, it's disruptive. And there's a lot of government regulations and different things like that, if you can start to just eat your way out of diabetes or whatever it might be, which we already know you can, it's just that the technology is going to make it easier to do so. And when you go to the grocery store, what do? You go down all the aisles and you're buying all this stuff, and the refrigerator doesn't need to do that. They know how to stay in a particular lane, and they're going to order this food, have it sent to your house, and all you got to do is put it in the refrigerator and eat what it says to eat, or just buy the pre-cooked meals and so on and so forth. It might be pricey, but at the same time, the rich are only going to get richer, and they're going to be wanting more and more lives of convenience. And I'll give you an example. A lot of the wealthy have their own private chef. They cook according to like this. But a lot of people, let's say, for example, you might make a lot of money, but you don't want a private chef. This thing can serve as your private chef. And in some cases, there's diets, and there's like the fitness world. These guys are getting these pre-cooked meals, and I think they're just getting better and better. But that's just me ranting and raving, but what I think in the future. And so I'm looking at this type of disruptive technology, and I'm building positions in our clients' portfolios in small scale around these things. And so going into the rate cutting cycle, you're going to see more and more things on the market. You're going to see more and more M&A, and you got to get ahead of this stuff. So if you're interested in learning more about what we can do for you in your portfolios and how you can be a part of our new revolution in terms of how we're getting our clients retired faster, I'm telling you, the rapid retire, I'm excited about it. A lot of people are getting out of jobs. And I'm not saying they're getting out, for one particular reason or the other. It's because they choose to say, hey, I'm at the 2 million mark, the 3 million mark, 4 million mark. We got enough money. I'm going to inherit all this other money over here. We don't need to keep doing this. We can go find our true purpose and our true passion, and then just do that until the day we die. So those are the kinds of things that I'm excited to help people with. And if you want to know more about that, get in contact with us through the website, reach out, request a conversation, and we'll get it hooked up for you. So thanks for tuning in to today's review and update. Until next time, everybody, 1, 2, 3, let's get it.
This is thepodcastfactory.com.